For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about volatility, rates, and retirement. What should you do now? Should you invest when the market is at an all-time high? Also, we'll talk about retirement mistakes that you'll regret forever and how to avoid them. And then finally, 5 Ronald Reagan quotes retirees should live by. My name is Jeff Shade. As always, I am just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd at Floyd Financial Group. Good morning, Randy. How you doing today?
Doing very well, Jeff. How about you?
I'm doing fantastic. And Jake, glad to have you along. How are you doing?
I'm doing great, Jeff.
Glad everybody has had a chance to join us today. We certainly hope that you are having a great Saturday. We've got a good show lined up for you today. And we'll start it off by talking about volatility, rates, and retirement, what everybody should know. Randy, retirees are hearing about market volatility, tariffs, slower growth, and interest rates staying higher. At a high level, how should retirees interpret all of this noise?
Turn it down.
Turn it down. I think that's a good one. There's a volume knob on the left. Turn it down.
Oh, my goodness. Yeah, as I talk to people in here every day, we sit down and we say, well, how you been? What's going on? They say, yeah, tell us what's going on. There's so much in the headlines right now, and all that, of course, creates doubt, creates emotion, and people start to wonder, hey, what's going on with my retirement? Can I retire? Am I going to be able to in the next 2 to 5, like we discussed? Has something really fundamentally changed that's going to drive the market down right now? The long and the short of it is anytime we have any type of headline. So I remember back during COVID, I had a gentleman that walked in the door over here that had worked for AT&T. He says, hey, I've been listening to the radio show. I'm here to retire. He said, you think I can do it during COVID? And I said, absolutely. I said, we'll just have to take some really careful, painstaking, let's look at what you really need. Let's look at where you are, and let's work out a plan. And when we work out these plans, we need to make sure that they work in all kinds of financial weather. So really, sometimes, and this is going to sound strange when I say this, it's almost okay to retire in a down market if you can see your way to do it, because we know that the other side of that is bright, sunshiny days.
Absolutely. We talked before, I think it was about Mr. Brown, Mr. White, Mr. Green, whatever it was. And if you retire today during an up market, it's a little bit different than if you were to have retired during COVID. So that's called sequence of return risk. For the people who have not heard us talk about that, let's talk about it, because a lot of people don't understand it. Sequence of return risk. Why is this so important right now?
Yeah, it sounds like, in fact, there's been a lot of people over the years that would get on TV or on the radio or write courses about retirement, and they'd say, well, the S&P 500 has returned 9.12% for the last 5 billion years, so you can go ahead and withdraw 10% and not spend your money down. Well, that's not necessarily true, because that Mr. Brown and Mr. Green story we talked about,
right,
they had the same retirement returns as a percent, but one retired in a down market, the other one retired in a really strong up market, and one guy ended up with a lot more money than he started with, and the other guy, due to those downturns happening early on and not being prepared, that's the thing, not being prepared for it, he went broke by the time he was 83, so he retired 65, 83, he was dead broke. The other guy at 83 had over $3 million, and they both started with $1 million. So there you are. There's kind of the story of, we don't know how it's going to happen. We don't know how markets are going to react, but we have to have a plan for all types of financial weather.
And Randy, you talked about withdrawing 10% during good markets. Typically, what are we looking at for a withdrawal rate? I know that there's the 4% rule. How has that changed with today's market and today's economy?
Yeah, I think with the proper tools and the right type of planning, I think we can do a little more than the 4% rule. We're going to tell you that we can usually do 5 sustainable and probably grow your money a little bit beyond there. And some people say, is that all just 5%? That means I get $50,000 a year off $1 million. Well, I can remember here not long ago when a CD would pay you about $10,000 off of $1 million. We like the market. We have to be careful and make sure that we're ready to mitigate risk when things are not good. But again, the 10% rule, doesn't apply unless you just want to go broke.
Exactly. And I don't know anybody who wants to go broke, but there's a lot more possibility of doing that. Typically in retirement, I'm counting on 20, 30 years. What do you build in? How far do you run your plans out for?
Yeah, we're generally running to 90 or 95 because nobody wants to get there and be out. Now I have some people that say, hey, I just want to make sure that the last check I write bounces.
Yeah.
Right?
I've heard that one before, too. Hey, kids, I worked for it. You're going to work for it, too. I'm going to leave you nothing behind. Talking with Randy and Jake Floyd Financial Group, our number 417-889-7233. If you hear anything that piques your interest, you'd like to get in and sit down, talk with Randy and Jake here at Floyd Financial Group. Talk about your journey towards a confident retirement. There is no cost, there is no obligation, and there is no judgment. We'll meet you where you are. We're talking about volatility, rates, and retirement, what you should do right now. For years, Randy, bonds paid almost nothing, but now rates are higher. Is fixed income attractive again?
Well, fixed income became attractive in probably starting in about March of 2022.
Yeah, exactly.
When Jerome Powell started raising interest rates, because Ben Bernanke, if you remember before him, had interest rates at near zero for a very long time. And so 10-year Treasury bills were probably paying 1.5% or 2%. And of course, he took over 14 months and raised the Fed funds rate from basically zero. That's what banks borrow money from the federal government for, and took it to 5.25% and nearly put some banks out of business because all those bonds got devalued. So remember, when interest rates are low and they spike up, it devalues a bond. When interest rates are high and they're falling, it increases the value of a bond. So yes, bonds are a little bit more attractive than they've been and could be, depending on how far down Mr. Kevin Warsh, our next guy coming into the Fed chairman seat, depending on what he does with interest rates, they could do a little better than what their actual interest rate is. Right now, I would say intermediate term bonds are probably in the 4 to, you might find some that are on the higher risk side to 5% yield. And the value of those bonds could go up if we, in fact, see interest rates going down.
So Jay Powell is a lame duck Fed chair at this point. Warsh is coming in here, I guess you could say. And what do you think Warsh is going to do here? Is he going to follow more in line with what Trump wants?
He's going to wash clean the sins of Jerome Powell.
I was wondering if you're going to bring that up. From my part of the country, W-A-S-H, I'm going to wash the clothes. It's the same way in Missouri, I guess, huh?
What I think's funny about that is the old movie Sling Blade.
Oh, yeah.
What's that guy's name? My goodness.
Billy Bob.
Yeah. So that was one of the best roles I'd ever seen Billy Bob in. He's talking to that kid. He goes, how far you got to tote that wash? And so every time I hear that, I think about that.
Well, I've got an aunt, like I said, who I've discussed before. I've got an aunt who's 108, and she calls it Washington, D.C., too.
Yeah, that's right.
It is a regional thing.
Well, growing up in Bradleyville is not the mecca of education.
Sure.
But anyway, we always thought it was Chicago, Illinois.
And the horse pistol.
Now, I've heard the horse pistol before, too. My dad used to say that.
What was the question?
Basically, it's what do you think Kevin Warsh is going to do here? Is he going to follow more in line with what Trump wants?
Yeah, I think if we had Kevin Hassett, he would have been an absolutely 100% yes man to Trump. I think Warsh has got enough experience. Number one, he's been a Federal Reserve Bank president, and then he's got the big role now. So he'll know how to play the game with those people. But I think he's going to, again, this is going to sound like a Jerome Powell quote.
Yeah.
He's going to be data dependent. But I think he has the ability to maybe foresee more than what's right in front of him than Jerome has.
Here's what I really think, too, is I think this is totally orchestrated by Kevin Warsh and Donald Trump
right.
to make it look like Donald Trump has moved backwards from the Hassett pick.
Okay.
So Kevin Warsh is going to appear more like one of the boys over here at the FOMC. But I think they have a plan. But I don't think it'll be long until you see Trump jawboning at Kevin Warsh saying, why isn't he lowering interest rates faster? Even though they probably have a plan behind the scenes, but they don't want it to look too much like they're colluding so that he can get actually confirmed by the Senate and all that. Because obviously if he doesn't get confirmed, he can't get in there and do his job.
Right. So here's the delicate balance that we have to look at. We need production. We need productivity. Because if we have plentiful supply of things, that tends to drive prices down, right? But we also have to be careful not to make the economy get too hot to where now it drives up wages and drives up prices further. He does have a difficult job, no doubt, but they have a lot of ways that they can see a lot bigger picture than we can and really see how things are coming together and how that puzzle is developing. So
Trump isn't going to make it easy on him, though.
No, he will not.
Can you imagine working for Donald Trump?
I can't, actually. I agree with 98% of what he's doing up there, but would not want to work for the guy.
You wouldn't want him to be your boss. Okay, let's continue this conversation by talking about stock market rotation. Recently, I mean, we've seen leadership shift away from heavy tech concentration. Do you think that this is a sign that retirees should maybe follow the herd and rebalance a little bit?
So let's talk about that a little bit. So number one, whoever was designing the retirement portfolio should have had in the back of their mind, yes, we're heavy technology. We need to be watching technology. Now, here's the thing. Long term, AI and technology is here, and it's going to grow and grow. Are we going to have some momentary reset here? This is not 1999, though, where it was a lot of promise and nothing happening. As you have alluded to here, even with me behind the scenes, AI is something that can help shorten your timeline as we develop these shows week in and week out. And it's the same for us. There's things that we can use through AI. And it's going to be more and more, and that's going to help us up production on many fronts.
But make no mistake, there is no way that this market can advance without technology participating. So I would say that the time to rebalance out of technology was 4 or 5 months ago, if you were going to do it. At this point, I think over the next 2, 5, 10 years, I don't think we can afford to not be invested in technology.
I agree.
Because it's going to be the driver forward. There will be other companies that win based off of their adjustments that they've made to their business to favor AI and to favor the coming environment. But we really need to be careful. There's a lot of people thinking that tech will not continue to win because they've been winning. Innovation drives business, and business drives profit, and profit drives stock prices.
Right.
And so that innovation is this jumping off point of all this. And I think that, like Randy said, it's not going to go straight up in a straight line. It's going to be up, down, and all around. A lot of the volatility caused over the last few weeks is really in the software sector. People are questioning whether software will continue to be a thing if AI can just write it in 5 seconds. And what we need to remember is that behind the software is knowledge and experience. Kind of like if you go get a trust done at a lawyer, you're not paying them for the words on the paper. You're paying for their expertise for the last 10, 15, 20 years, whatever. And in that same fashion, these software companies will continue on. They're not going to cease to exist because AI can write a program. AI will make typos and stuff and create issues. AI is a tool, but it cannot be fully trusted at this point and may not ever be able to be fully trusted from a philosophical standpoint.
Right.
All these things will still be necessary. AI is not going to put everybody out of business. But again, I would be careful to get rid of too much technology here, as I don't think it's possible for the market to continue onward, upward without tech participating.
And as you mentioned, Randy, I mean, we were talking what we use AI for. I use AI almost every day, from a variety of things, all the way from why doesn't my 71 Mustang start, all the way to philosophical questions, all the way to looking for topics that would resonate with our listeners. So AI is a very important part of our lives today. I think it is as, if not more important, what do you think, than the development of the internet and also websites? How do you feel about AI and its importance?
Yeah, so it's going to be very important. In fact, it's kind of funny that we're talking about this because just this morning, my little brother's coming in this weekend to visit. And so my wife and I were talking at the breakfast table about maybe a little excursion we want to take and see some of the old places where we used to live and go down to where my mom and dad are buried in the cemetery and all that. And so she said, well, what does that route look like and how long would it take and all that, the thing we wanted to do. So I pulled up on my laptop, I pulled up my little AI thing there and it says, hey, Randy, how can I help you? So I told it what I wanted to do and the points I wanted to see. And I said, oh, by the way, is there anything else, and any other points of interest we might want to be interested in as we go through there? And it built me a route, told me all the places, showed me the roads, and told me how long it would take to drive it. Now, I could have done that on my own, but how long would that have taken?
Probably all day, easily.
So people say, well, yeah, but that's just for your little weekend trip with your brother. Here's the thing. Everything is somebody's weekend trip with their brother. Every problem, every scenario, every exercise we want to do or endeavor to do is the same thing. So it's going to be a huge piece.
Randy, let's wrap it up here by talking about 3 practical steps that retirees should consider right now, considering all the things that we've talked about, the market and the economy. What do you think people should really be focusing on here?
Yeah, I think at this point, the AI thing, people just need to be patient. It's going to get done. The idea of investing in what we would call consumer staples and a lot of things, those things they're priced up pretty high comparatively. They're almost as expensive as AI in many cases. In fact, in many cases, they're more expensive than some of the AI players. And their days having strong growth and generating big profits are probably behind them. But really what people need to think about as they're getting close to retirement is, number one, do I have somebody that looks at this stuff on a daily basis, understands it, and knows how to navigate it? Number two, do I have somebody that's got the experience behind them at navigating it? And number three, have I really engaged in making a plan with that person? And so I would say that the biggest thing is we got to have a plan, but you got to have somebody with the necessary experience to guide you to do that. And I will tell you, Jake and I worked together in this business where Jake's been here, he's 19 years in. Mm-hmm. This is definitely not his first rodeo, so to speak. And he loves this business. He loves the people in this business. When I'm talking about the people, I'm talking about our clients and what's best for them, and does his due diligence on a daily basis.
Well, we love having both you and Jake on the radio program, and I want to talk to our listeners here for just a moment. Folks, if today's conversation has made you realize you're not quite sure how your retirement plan would hold up in this kind of market, that's exactly why we're here at Floyd Financial Group. Of course, we specialize in retirement planning, not just growing money, but turning it into dependable income that lasts. We stress test your portfolios. We take a look at things like sequence of return risk and evaluate whether you're taking too much risk or maybe not enough. And of course, we help you understand clearly and simply where you stand. If you're within 10 years of retirement, you're already retired, this is not the time to guess. Call us here at Floyd Financial Group, 417-889-7233 to schedule your complimentary retirement review. There's no cost, no obligation, no judgment. We'll meet you where you are. You'll walk away knowing whether your plan is built to survive volatility, inflation, and a 25 to 30-year retirement. Once again, the number 417-889-7233. We would love to hear from you. Time for a break. Randy and Jake, we come back here on Show Me the Money. We're going to be talking about whether or not you should invest when the market is at an all-time high. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, I get this question all the time. Randy, should we invest now when the market's at an all-time high or near it?
Yeah, and Randy, the market just hit another all-time high, 50,000 the Dow was, and a lot of folks are a little bit nervous about that. Do you think that their fear is justified?
Let's talk about that for a second. It's such a great question, actually. So you have to remember that to get to here, we had to go through all-time highs since we've been tracking this since about 1895. We had to go through every one of those and create all-time highs all the way through. One of the things that is kind of interesting is as a government, the government controls our money supply. And every time we increase the money supply, guess what happens? The markets go to a new high. Now, we don't know the exact timing of how that's going to play out, but we know it's true because money, once it enters the system, is going to do what? It's going to find a home somewhere. Some people are going to stuff it in their mattress. Some people are going to put it in their backyard. Some are going to put it in CDs. Some are going to put it in the market, and some are going to put it into real estate, right? But I will tell you that generally speaking, the vast majority of the money ends up in real estate and somewhere in an investment. So with that being said, it's completely normal for people to feel nervous about new market highs, thinking, is this the end? Should I be getting out now? It's funny, I was watching this TV show the other night, and I think it was an old episode of Law and Order.
Yeah.
And this guy was an investor on there, and he was saying, well, I know this one thing about this woman. She would never buy a stock without putting a 10% stop loss underneath it. And I thought, well, we now know that that's probably one of the dumbest things that you can do because market volatility is a real thing and it's going to happen. And if you are always so nervous that you can't take any type of a downturn, you're not going to be able to stay in to get the good returns.
Also, a fun fact about that, the algorithms and the banks and everybody can see your stop losses. So they know where your stop losses are, and they'll use it against you.
Yeah. So think about this. Since 1926, the market has been at an all-time high about 31% of the time. So we know this. Markets are up generally about 70% of the time. And so it's that 30% that we have to watch out for. But if you think about that, that means that nearly 1 out of every 3 months since 1926 has been a record high. That's pretty crazy to think about.
Yeah.
But we know this. We always, and we have been, and we probably always will print more money.
What did you say once? QE to infinity or something like that? I forget what the comment exactly was, but yeah.
Yeah, that's what Jake says. QE to
infinity.
And it's true. I mean, here's the thing. There's really no government that's exempt from that. Everybody's doing it. Now, some are doing it at a faster pace than others. And granted, here of late, we've been doing it at a pretty fast pace since COVID.
Yeah.
We threw all that money into the system. I don't know who coined this phrase, but Jake has said it many times, that the market climbs the wall of worry.
Yeah.
And it does. I mean, it truly does. So what we have to remember is let's be grounded in what's happening rather than getting emotional and fearful.
And the stock market, I mean, the Dow reaching 50,000, it was 1,000 people were saying, how high could it go? 2,000, it can't go any higher than that. 50,000, I'm sure we're probably going to see 60, 70, 80, 90,000. So let's continue this conversation here, Randy and Jake. A lot of people have moved into cash because the rates look attractive. Is sitting in cash right now a safer move?
So yeah, that's a great question, Jeff. So is cash safe? Yes. Is it making you much money? No, it was for a while back there. There were some banks and people that were paying 5.25% interest on money market accounts, as well as CD rates. But now, and I've been listening to people coming in the door, because this is what happens when CD rates and money market rates start to go down. People keep coming out of the woodwork with money. So this guy says, I got about $350,000 over here. I was getting $500. Now they only want to pay me 2.87. So all of a sudden, we're seeing that banks are seeing the handwriting on the wall right now. That's why they are reducing the rates that depositors are getting now on CDs. So we had people that had money in it 4.5, 4.7, even some back there a year or so ago at 5%. But now we're seeing that the banks are coming in at 3.5, 3, even some less than 3, and they don't want to be stuck holding the bag. So is it a good investment? Yes, it's safe. Is it going to really yield what you need it to? Probably not. Now, the thing I'd like to point out here is let's compare the raw returns of the market versus maybe a fixed rate on a CD. And we're going to use the rule of 72 to calculate this. So let's say that we have a 3% rate on guaranteed income on our money. So we invest $100 and we follow that money at 3% interest compounded for 96 years, and we have $1,600. Sounds pretty good, 100, so we got 16 times our money. However, if we'd taken that same $100 and invested that money in 1926 in the market, in 2024, we'd had $103,000. So kind of a little difference in the comparison there. Now, I'm not saying everybody should go out and throw everything they got in the stock market and throw caution to the wind and pick the most volatile thing that you can. I'm not saying that. I'm just saying that we need to use these tools where appropriate. Yes, if you have ready cash on the sideline that you want for emergencies and things like that, CDs and money markets can be great tools. But as a tool to protect you against inflation and grow your retirement, not the best tool.
Talking with Randy and Jake of Floyd Financial Group, we're talking about should you invest when the market is at an all-time high. So, Randy, what happens if someone tries to avoid investing every time the market hits a new high like it is right now?
Here's the problem. Once you pull money out of the market, it's very hard for people to know when to go back. And generally, they're going to wait too long. Almost all the growth is going to happen before they go in, and they're going to come to the end of the cycle. Then it's going to go down. They're going to get scared. They're going to pull out again, and then they may never go back. And they may say, the market just doesn't work. It's too big a gamble. I'm not going back. So that's the thing you got to be careful of. And again, we talk about the fact that, there's emotion involved in managing money. There are people doing it themselves, especially. I think at this point, after 25 years for me and 19 for Jake, we're pretty good at taking the emotion out of investing at this point. And we're trying to look at the cause and effect of everything. Now, the cause and effect, we understand. The exact timing is what nobody can say.
So considering all that, Randy, what should investors focus on right now instead of the fact that the Dow is 50,000 all-time highs? You talked about emotion.
Yeah. So the thing we need to look at is what's happening right now economically. Where is growth maybe going to come from? Also, in my situation, what's my capacity for risk? Not from an emotional standpoint, but also from an actual numerical dollars and cents standpoint and the emotional side. Let's build a portfolio around that, because what's really important is as we invest people's money is that they're willing to stay the course. Now, that doesn't mean that we're just going to set it and forget it. We're not. But they need to stay the course with us. And our job partially is to figure out how people feel and how to keep them invested and safe and earn a decent return all along the way. And that's what we do here every day. And people say, well, AI is going to replace all the investment advisors' jobs one day. No, because we're emotional people and AI is going to be logic, those two things don't work that well.
Randy, let's take out of the equation the Dow hitting 50,000 and where we are right now. Is there ever a good reason or a good time to reduce stock exposure in a retirement journey?
Well, here's what we know. We know that generally speaking, when the Federal Reserve is raising interest rates, that's hard on stocks. We know when they're lowering interest rates, that's generally good for stocks. And I will tell you that there's a whole curve along the side of those two things, right? Is it going down? Is it going up? Is it level? Also, we have to just look at what industry is doing and what new widgets are out there for sale on the market and what significance they have, kind of like AI right now today.
So, Randy, considering all the things that we talked about here, the stock market being at an all-time high and the fact that investing is largely an emotional thing, what do you think the big takeaway for listeners is today?
So I would think that the biggest thing today is, again, if you don't have somebody that has really gone over a plan with you or not, if you're somebody who wants to invest all your own money, that's great. That's fine. But you better be willing to commit the time to it that you're going to need to commit to that, and also remove the emotion from it to be able to make good decisions doing that. But if you haven't talked to somebody that knows this stuff and understands it and has lots of experience, I'm talking years of experience, managing money and building portfolios, you need to do that. It's important that you have a plan. I don't remember who said it, but anything that's measured tends to improve. And so as we start measuring where we are, what we're doing, why we're doing it, that's going to improve your outcome when you get to retirement or even through retirement if you're already retired.
Great conversation, Randy and Jake. Folks, here is the bottom line. Markets hit new all-time highs because over time, businesses grow, innovation continues, and economies expand. If you're sitting in cash because you're nervous, you're not alone, but history is clear. Avoiding the markets at an all-time high has cost investors significant long-term wealth. If you'd like some help building a disciplined retirement plan that isn't driven by the headlines or fear, Randy and Jake, the team here at Floyd Financial Group, are ready to help you. So reach out to us. Have a conversation. Make sure your money is positioned for long-term goals and not just short-term emotions. Call us at 417-889-7233. Request your Floyd Financial Group review. There is no cost, no obligation. There's no judgment. It is just a friendly conversation. It's a casual conversation. It's always a no-tie zone at Floyd Financial Group. Once again, it's 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Randy and Jake, time for a break. When we come back here on Show Me the Money, we're going to be talking about retirement mistakes you'll regret forever and how to avoid them when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shane.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about retirement mistakes you'll regret forever and how to avoid them.
That's right. Let's start with the big picture. Why do so many retirees sabotage their own golden years, Randy, with these mistakes?
I think part of it is you've worked a long time and you're trying to get somewhere, right? And you finally think, hey, maybe I've arrived here, right? And so vacationing is one of those things that most retirees want to do. So it's easy to get over, what was that called? What did Greenspan call that? To have irrational exuberance.
Right.
As you go into retirement.
I like that, yeah.
And, you know, it was funny. There's a lot of misconceptions out there. I was reading something just like yesterday that said, yes, if you earn $86,000 to some number around $100,000, you will need 86% of what you earned when you worked to sustain yourself in retirement at the same level. Now, for one that has been partially retired for a couple of years now, I will tell you that I'm not so sure that that's true. Because all the time you used to spend at work, you have to fill that time, right? So I think one of the things that people need to really consider when they retire is, really what am I going to do with my time? Am I going to volunteer, or do I have a hobby that I love to do? Do I want to visit family? Do I want family to visit me or not? All these things. But really, I think it's something that in decision making, you probably should look at it and then consider it, give it a little time to cool off and think about it again and see if it's really what you want to do. A couple things out there is always rent before buying, right? And I will tell you, I've owned a boat, and now when I want a boat, I just rent one.
That's right. I would agree with you completely. And people relocate on a whim, and I think that is one of the biggest retirement mistakes. We don't have the most hospitable climate here in the wintertime, so they'll, on a whim, buy a place in Florida. What's the risk of relocating too quickly?
Well, I will tell you this too, and I've considered a lake house. I've thought about doing all these different things. Now I've just got something else to maintain, manage, insure, and worry about.
I think the biggest risk to relocating to Florida or having a second house in Florida is that you don't know who the next governor is going to be, and Ron DeSantis is on his way out.
That's right.
I've thought about that, and Florida's a little hot for me, but from a political and economic climate, Florida's about as good as it gets on the globe right now.
Right.
From a tax versus earnings versus cost of living standpoint. But I do think that there are people that own a boat that are on that boat 3 or 4 days a week for the entire season.
Yeah.
And if that's the case, you should own a boat.
Right.
If you're going to go 2 or 3 weekends a year, it doesn't make sense to own a boat. The same is true of your Florida house. If you're going to go from November to April and live down there, then sure, that could make sense, assuming it makes sense for you economically. If you're going to go down there 2 or 3 weekends, you should just get a nice Airbnb and save yourself a boatload of money.
A boatload, that's right. Or you could actually even stay at the Ritz-Carlton.
Yeah, exactly. For the same price of owning a boat for a couple of months, you could afford to stay at the Ritz-Carlton.
You know what's funny about that? I did price the Ritz-Carlton. I'm going down for a bike race in June. And so this place, it's at Key Biscayne is where it's going to be. So I was looking at getting an Airbnb. My wife says, well, we could just stay at the Ritz-Carlton. I said, well, I guess we could, So we looked at the Airbnb that's right where we wanted it to be, and it was $250 a night. Guess how much the Ritz-Carlton was?
$1,100.
$1,400 a night.
I was going to say that, but I thought I better not say that. $1,400 a night. Wow.
I'm like, these people are definitely on drugs.
But there are people who pay it. I guess they've got more money than good sense. But just on general principle, I've got to draw the line somewhere. And yeah, a lot of things you're talking about are exactly right. Vacationing somewhere is not the same as living there. Cost of living, insurance, taxes can surprise you. But I think one thing that people don't realize when you move permanently is that social network loss is real. Loneliness is common. You got to make some new friends. And many times in places like that where people come from all over the country, sometimes all over the world, people are not as friendly as they are right here in good old Springfield, Missouri. So relocating on a whim definitely is something that you do not want to do. Timeshares. What is the trap with a timeshare?
You might need to call MacGyver to get you out of it, depending on the situation. So as you know, we live in a pretty heavy timeshare area because we're close to Branson and that kind of thing. I think I know 2 people that are happy with their timeshare. I think 2 couples that I can think of off the top of my head out of dozens that I know that have them. They're pretty good at selling them. Anything that requires a hard sell, you should take a pretty hard look at.
Absolutely.
And there's very few things that they sell harder than a timeshare.
There are large upfront costs for these timeshares, rising maintenance fees. You never know when they're going to raise that. They're hard to resell. There's an oversaturated market. Travel costs add up. An emotional purchase is not financial logic. Borrowing against your home. A lot of retirees are house rich but cash poor. Should they tap equity, do you think, Randy, or is that a big mistake?
There's a couple of ways to go about that. And there are situations where that can make sense to use a reverse mortgage. The HELOC is something that I'm not a big fan of. Now, once in a while for something short term, or if you need to do a repair or something, that's fine. and then you can pay it off over time. That's fine. But the HELOC is very interest sensitive. It's the prime plus. So a lot of the HELOCs that people took out and they were at 5%, well, they're now at 10% on those.
HELOCs are the credit card of mortgages.
Yeah.
That's a fact.
Home equity line of credit.
Yeah, the banks love those. And so the reverse mortgage, on the other hand, is a little different. The reverse mortgage, basically, you can, if you're 62 and older, you can get roughly half the equity out of your house, either in a lump sum or you can derive an income from it. And what's nice about it is it's a loan, and so you don't pay taxes on that money, so it stretches the money a little bit further. And a lot of people say, well, once I do a reverse mortgage, I've given up my home completely and I can never sell it and my kids will never get anything. And that is absolutely not true. Now, this is not a reverse mortgage seminar, but I will tell you that there are times when reverse mortgages can be a real godsend for people that need a little extra money, or if they've come up against something that they didn't expect where they need a chunk of change, they can get it. But generally, with people that are house rich and cash poor, if they got a big house, they can downsize and maybe come out better there. But reverse mortgage is not something you want to go into and take lightly, but it is something that can be a very valuable asset, or move, I should say, with one of your assets. And I will say this too, even at today's interest rates, which are probably on the reverse mortgages in the 5 to 5.5 range, it takes a very long time for you to eat up all the equity in your home.
Randy, we talked about this just a few minutes ago, and we're talking about retirement mistakes here. Some people just don't trust the market. They don't trust the stock market. They do not invest in the stock market whatsoever. Is that a mistake, do you think?
Well, if we look back historically and look at just the dollars and cents side of it, it's a huge mistake. If you put in the emotion and the comfort of people that just don't like risk, it's probably not such a big mistake. Again, it's all perspective.
I think that to not invest in or around the stock market, we won't say directly in because that's a little bit unfair, but in or around the stock market, to not invest there is to bet against American innovation and ingenuity. And I think that's a mistake. And over any time span, including back to the late 1700s, that's been a mistake. It doesn't mean that all your money belongs in the stock market, but to simply bow out of it has been a mistake for the last 200 plus years. That doesn't mean it will always be a mistake, and we can't predict the future. But if history teaches, and it does, having a way to invest either directly or indirectly into the stock market without putting your money at risk in some cases can be a good way to do that. We've talked about fixed indexed annuities. I believe we're kind of in the last hurrah here of interest rates before they will not make as much sense. And fixed indexed annuities are very dependent on interest rates at the time you take them out. But you can get the lion's share of the gain when the market's up and none of the loss when it's down. And so that can be good for people who are more risk averse, or for a portion of your money in retirement so we don't look at getting wiped out if the market has a bad year. But I do think we're probably, in my opinion, in the last 6 months of the attractiveness of the fixed index annuity, because as interest rates go down, they become less attractive. And I think interest rates are going to go down in a pretty big way. Again, that's a guess, but it's an educated guess over the next 6 to 18 months.
Yeah, and there are many tools, like you said, Jake. There are ways to participate indirectly in the market with some safety valves, the fixed index annuity being one, this newer thing called the RILA being number two. There's lots of ways to do that, where just betting on a 2 or 3% interest rate to fund retirement or to grow your money, man, at 3% takes 24 years to double your money. And if we look back over our shoulders since 2020, when the market was at an all-time high going into COVID, through about 3,373, I think the S&P 500 was, then it went down about 18%. But since that time, we're at 6,000, 6,800, maybe at the time, 6,900. So you would have just nearly doubled your money since COVID. So 5 or 6 years versus 24. I don't know
if you're in the raw market.
If you're in
alone.
the right, exactly,
yeah.
raw market. And I'm not saying that everybody should have done that, and nobody had the exact timing to do that, but I'm just trying to illustrate the difference of what I call dusty money versus money that's working.
Talking with Randy and Jacob Floyd Financial Group, we're talking about retirement mistakes that many people make. Our phone number, 417-889-7233. If you're guilty of any of these mistakes, give us a call, and we'll see if we can help you undo those. This is a big one, claiming Social Security too early. Why is that a problem?
Well, we are living longer than we ever have before. But let's really talk about that for a second. So we have a lot of clients that are hitting nearly 90 or some that are more than 90 and a lot in their late 80s. But we also have a lot of people along the way that die in their 60s and their 70s. So the average man right now in America lives to about 76.8 years. So, and there's a lot of things that play into this, but this is just one angle on it, right? So a lot of what plays into it is, how's my health at 62? Do I need to take Social Security? Have I been disabled before that and I'm already on some type of Social Security disability? Am I sick and tired of my job and I have enough money so I can go ahead and take my Social Security? Or am I in a position where I'm working part-time now, I can take Social Security and not make more money where I have to start paying some of that back to Social Security, right? So there's a lot of different scenarios that come into play. But if I'm 62 and my health is average, that means I'm going to live, and nobody's average, right? But 76.8 gives me 14.6 years to live, or 14.8 years to live, right? So if I wait to age 70 to get the bigger payout, and it takes me 10 or 12 years to get even, will I ever get even? And when would I have had more fun in retirement, at 62 or age 70?
Right.
The other side of that is, too, if I live to even age 72 or 3, I've gotten all that money that I wouldn't have gotten until I started at age 70 again. So if you talk to people generally in the investment business, the rule of thumb they will give you is you should wait till age 70 to take Social Security. Well, that sounds good, but that's just not reality for everybody. So there's the emotional side of it again, and there's the dollars and cents side of it again. Some people, it does not make sense financially for them to do. Others, emotionally, it makes complete sense for them to do. And then there's everything along the middle. That's why each of these plans has to be individualized. You can't just blanketly say that one answer suits all.
Folks, here's the truth. Retirement doesn't fall apart because of one giant mistake. It falls apart because of small decisions that go unchecked for years. Claiming Social Security too early, not having a real income plan, taking too much risk or not enough, ignoring taxes. I think hoping it all works out. Hope's not a strategy. If you're within 5 to 10 years of retirement or you're already retired, this is the time to get a written plan in place. Not just guesswork, no rules of thumb, a real plan that shows how to generate income, reduce taxes, and make sure your money lasts as long as you do. If you would like a Floyd Financial Group retirement review to maybe spot some of these mistakes before it's too late, call us at 417-889-7233 and request yours at no cost and no obligation. Just a casual conversation here with Randy or Jake to put you on a path towards a confident retirement and avoid those potholes or those mistakes. Once again, don't leave your retirement to chance. Call 417-889-7233. Let's make sure you retire and stay retired. Randy and Jake, time for a break. When we come back, we're going to be talking about Ronald Reagan quotes retirees should live by when the program continues here on 104.1 FM KSTF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and now we're going to have some fun. We're going to talk about 5 Ronald Reagan quotes retirees should live by.
And Randy, we recently observed President's Day, and it got me thinking about President Reagan. You know, he's known as a great communicator. So I wanted to discuss some Ronald Reagan quotes that retirees should live by. First one is, there are no constraints on the human mind, no walls around the human spirit, no barriers to our progress except those we ourselves erect. How does that apply, that quote, to retirement today?
Many times people come in, and retirement is something we help people do here every day, but it's something that most people will only do one time. They've worked hard, they've spent a lifetime raising their kids, getting them educated, paying off a home, paying off a mortgage, getting ready to where they can at one point go and live the life they've always dreamed about, right? But here's the thing, it's not as easy as it sounds, and there's a lot of little road signs along the way that need to be adhered to and plans that need to be made. And so he's right. There's no constraints here except what we put on ourselves, but we need to really sit down and develop a plan and work within what is reality, right? But we also need to make sure that we are looking to the bright side, I think.
And I think what he was saying in that comment is that too many retirees mentally age themselves overnight. Retirement is not the end of something. It's not a shutdown. It's sort of a reset of life. The barrier is usually a mindset. It's not ability. So while you still have the ability, do the things that you've always wanted to do. And Randy, I know that you're a bicyclist and now you're involved with that quite heavily. And take a tip from Randy. If there's something that you have always wanted to do, let's say it's woodworking, anything like that, go ahead and seize that opportunity, reinvent yourself. The next quote from President Reagan is, we don't have $1 trillion debt because we don't tax enough. We have $1 trillion debt because government spends too much.
Yeah, so retirement can last a long time, and overspending early really can create a situation you don't want to be in later. In fact, I haven't done this extrapolation here recently, but even in a 25 or 30-year retirement, even spending an extra $50,000, $60,000 in the first 2 or 3 years out of $1 million portfolio is pretty amazing. And again, we talked about sequence of returns earlier. If you happen to hit a poor sequence of return, it can really be damaging long term. So again, when you build this retirement plan, if you know that you're going to be, as you say, in the go-go years early on and you need to spend some extra money, let us know that. We will build the plan around that so that we don't get surprised later.
The next one, I think, is my favorite of all of these. The best social program is a job. That's interesting. Retirees spend decades trying to stop working.
Yeah, so there are those people that are disabled and can't work and that sort of thing. And I understand that. And I want to help those people. I want to help support them. What we're saying here is, if you're laying sideways in the public trough and you could get up and go to work.
I like that.
Work does a lot of things for us, right? It provides income, stability. For a lot of people, it's our identity. The social interaction, is a good thing. There's just a lot of things that having a job and something to show up to and to keep you on a schedule. Our bodies, we have this thing called the circadian rhythm, and that basically says the body works best knowing what's coming next. Sleep, eat, work, and keeping us on a situation that's rhythmic, because let's face it, life is rhythmic. We got all the seasons.
Yeah.
We got sundown, we got sun up. In fact, I was reading the other day that between 1 and 3 a.m. is when your liver is working to cleanse your body. And between 3 and 5 is when your lungs are working to clean things up. And then there's also another deal between like 10 p.m. and 2 a.m. There's a chemical that your brain produces that doesn't produce any other time of the day. So there's
So does that mean you should not get up at 4 anymore to go exercise because your liver's not done?
And between 1 and 3, the liver, there are a lot of people in the bar between 1 and 2 a.m. Their liver is not doing what it needs to be doing. I was in the Ace Hardware store just yesterday, and I'm talking about this best social program as a job. There was a fellow in there. He must have been 75 years of age. He's working part-time. He's consulting. He consulted me on what sort of wire connector I needed for my particular job. He seemed to be pretty happy. Obviously, I don't think he needed the money from talking with him. He's a guy that I talk to regularly, but he has some purpose. He really enjoys helping people. And I think that's going to really extend the quality of his life. Do you think that we can take a tip from people like that?
Oh, absolutely. I would agree 100%. Look at Warren Buffett and his partner, Charlie, died. How old was he? 90?
Late 90s, I think.
Yeah. He was. Those guys worked. And they did it because they wanted to. Trust me, Warren Buffett hasn't needed the money for 50 years.
I think longer than that, actually. Yeah. Warren Buffett made his first investment at age 11.
Wow. I wonder what he invested in at age 11. Do you know?
So he invested in City Service Preferred, and he bought it at $38 a share. He bought some for him. Actually, he bought some for his sister. And he ended up selling it. He bought it at 38 and ended up selling it at 40 after some volatility. And then after that, it went to 200. And he's talked about how this taught him a lesson in patience.
Yeah.
Because he missed out there. Now, again, I don't agree with Mr. Buffett's politics, but his career as an investor is impossible to argue with. And he has executed probably 2 or 3 of the greatest trades of all time, including buying Apple at like 5 times forward earnings minus their cash, an investment that he's made over 60 times his money on since then, and did it with billions and billions of dollars, not like a small amount of money. So I think he's a very smart guy. I think that trade helped him develop patience, and then he has proven to be incredibly patient since then. He licks his chops when the market's on fire. It's like, hey, we're going to go in and make a huge investment somewhere.
So what was the height of the Berkshire stock per share?
About $825,000 per share.
Oh my
And
gosh.
there's actually documentation that there was like a janitor at the Berkshire Hathaway building back in the 50s that invested, I want to say, and I could get this number wrong, but I want to say it was $400 to buy 40 shares at $10 a share. And that same stake at $825,000 a share is worth, about $34 million or so.
Yeah.
I think probably the thing I admire most about Mr. Buffett is that he did not let that money go to his head.
Yeah.
And he still ate McDonald's every morning. He drank 5 Cokes a day so that he could support Coca-Cola, which is one of his biggest investments. He's drove a Ford F-150 and lived in a $200,000 house.
Yeah.
Still lives in that house. So now the value of that house is more now, probably in the $500,000-$700,000 range, simply because the house is worth more.
Right.
But you're talking about a guy that could buy most countries. He might be able to buy Greenland for Trump. Who knows?
Yeah, who knows? But to have that sort of mentality at age 11 to invest in something like Citgo, that is absolutely amazing. Talking about Ronald Reagan quotes here. Want to continue on before we run out of time today, guys. Next quote, life is one grand, sweet song, so start the music. This one really hits home for a lot of retirees who are afraid to spend.
Yeah, I would say that's true. We have a few people that come to us that have been saving so hard for so long over their life that they just can't stop. That's who they are. And I often tell them, these little furry things that run around on the ground and climb trees and take acorns and stuff them in the tree and in the dirt, even they realize that winter is coming and they're going to need to eat those later, right?
Yeah.
And so it's kind of the same way for people that have worked a whole lifetime. It's hard for them to turn the switch sometimes over to taking income. And so one of our jobs here is to show them how they can actually take income and how they can continue to maintain or even grow their portfolio while they actually spend some of those or eat some of those nuts they've stored up over a lifetime.
And the last quote here, I think, is rather profound. It's one of my favorites here. It's true that hard work never killed anybody, but I figure, why take the chance? What's the lesson here?
Well, here's the thing. At some point, we all get to the point to where it's okay to slow down. Now, Charlie Munger never did at 99, and Warren just did step away here recently. But retirement is permission to slow down, and sometimes you can feel guilty. And I've kind of had a few of those where I know that Jake's over here slaving over a hot keyboard.
Yep.
And it didn't last long. But anyway, you've earned the right to walk the beach, to just rest and take some time and enjoy life and spend time with your wife and your family and enjoy it. But I think that's a funny one, though. Hard work never killed anybody. That's what my dad used to always tell me is, Randy, get up, get out there.
That's right.
Work won't kill you.
Well, Ronald Reagan, he had a lot of great quotes. Those are just 5 of those. It's fun to remember President Reagan. That was a good time in my life, and I think for a lot of people, too. And I think there are a lot of great lessons that we can learn from people such as Ronald Reagan. Talking with Randy and Jake at Floyd Financial Group. We're almost out of time today, guys. But before we go, I want to remind folks that if you'd like to come and sit down and talk with Randy or Jake here at Floyd Financial Group about your journey towards a confident retirement, we are offering the Floyd Financial Group Retirement Review at no cost and no obligation. Just straight talk and honest answers about your retirement journey. To get yours, no cost, no obligation, call 417-889-7233. You can do it right now. Leave your name, telephone number. Ashley will call you back during the week and set up that appointment for you. It's 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Well, Randy and Jake, we're out of time for this week. I want to thank you for your time, but most importantly, as I do every week, I want to thank the great listeners here in the last bastion of sanity, Springfield, Missouri, for joining us. So for Randy and Jake, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.